Hey everyone, hope things are fine with you. I am not telling you my name again. Another feedback I got from one of our followers. You know who I am, right? So today we are going to cover a little bit on the technicals of debt funds. Some of you have asked me whether debt funds are 100% safe. What are the risks, if any, attached to it? So what I'll do is I'll try to cover up the safety of the debt funds, and I'll also cover up the technicals that we see while we are looking at the debt funds. Uh, some technicals are common to equity and to debt both, that we'll cover up in our next videos. But technicals which are persistent only to debt funds we'll cover up in this particular video. So first of all, the safety of debt funds. So what are the risks involved in a debt fund? So let's say if I've taken a bond of a particular company, the risks are probably two. One is, let's say if I have a mutual fund company, if I've taken a bond of, let's say, XYZ company, what if that company defaults on its payment? So let's say the company has borrowed 25,000 crores from me at a rate of, let's say, 9.5, 10%. So that 10% is sure that I'll get. But what if the company defaults? What if they don't pay me the interest on either the capital? Then what? That's one type of risk. The other is, let's say that's fixed at 9.5. Let's say I've taken a government of India securities at about 8%, and what if the rate falls? Then what? So to address these two issues, let's take an example. Let's say if I am a mutual fund company, and let's say if I've taken 20, if I've given a loan to a particular company at 25,000 crores at a rate of 9.5%. Now, what are the safety levels that I have in this deal? First of all, these companies which I invest into, these are all rated by the government agencies like ICRA or CRISIL for that matter. So I invest in companies who are AAA plus rated, or probably AA, or a probably A plus, not below that. So these companies like ICRA, CRISIL, these are basically Brickworks for that matter. These are all rating agencies which gives a rating to a particular company based on the debt that it has borrowed from the market, based on the repayment, based on its payment cycles, its cash flows, its profits, its directors, a lot of factors that they keep into mind. So once they come out with a rating, the rating is a clear indicator of what's the chances of a particular company to default. So one risk of default, one part of the default risk is covered there. So I am investing in companies which are well rated, which are good rated. The chances of default is less. Secondly, if I am giving out a loan to a particular company of the magnitude of 25,000 crores, I have equivalent assets or more than that. In some cases, in today's time, we have more than 200% collateral backed assets. What does that mean? That means if I've lended about 25,000 crores to a particular company, I have taken an asset of close to about 40,000 to 50,000 crores from that particular company. Now, before defaulting, let's say if I have borrowed in the market, if I borrow 25,000 crores as a company, and about 40,000, 45,000 crores of assets of my company are under a lien, under a collateral, which is given for this loan. First of all, I'll try not to default on this particular payment, because against a borrowing of about 25,000 crores, I have to lend out an assets of close to about 45,000 crores, which doesn't make sense for me as a company. Secondly, even if I'm out of cash, I'll try and borrow from some other sources and pay out that 25,000 crores to the company from who I've borrowed from. rather than giving out my assets which are close to about 25,000 crores, right? So, when a mutual fund company invests in a particular company, these deals are all asset backed. They are, close to about 200%, 150 to 200% of collaterals which they have taken. Uh, so even if the company defaults, I have collaterals with them, off them, which I can sell off in the market. Another question comes: what if if something like a Vijay Mallya thing happens right now, where the assets are also very difficult to sell out in the market? Then what? So, most of the mutual fund companies, this happened when one of the companies, and I'm just taking an example of the same. This happened with Primerica. When they bought a paper of Deccan Chronicles, I think back in 2010, 2011, and once there was a default from Deccan Chronicles. What they did was they took the entire loss on their own books. So, to cover default risk, there is a multi-level protection layer. First is the rating agencies, where we are investing in good rated bonds only. Secondly, they are collateral backed. More than 200% is collateral backed. We can sell off their assets and recover the money. Thirdly, these companies generally, take some portion of the losses on their own books. So, more or less, they cover the default risk for the investors. The second is the credit risk. What will happen? So the second is the interest rate risk. What will happen if the interest rates go down? So for that, I'll come to the fact of the interest rate risk after I explain you certain technicals. So in a technicals space, we take the following criterias when we choose a debt funds. I'll just point towards the technicals which we look into.